This is a session, the title is Time to Rewrite Our Investment Playbook, ? And we have two great guests with us who are going to kind of have a panel, and they might disagree, and that's fine. I'm just going to ask a few questions. I'm an amateur. I'm a dean of a business school. I'm a strategy professor, so I'm not an expert like many of you all are. But I'll ask a few questions up front to get the ball rolling, and then I'll turn it over to all of you. And I'll first introduce, well, we've met Marc Seidner like 3 times today. Marc is as an alum of BC. But the reason he's here, I don't think I ever said this, but now I'll read it so I'll get it right. He's a CIO of non-traditional strategies and a managing director at PIMCO in Newport Beach, tough lifestyle. And he's also a generalist portfolio manager. So Marc's life is investments, not just being a trustee at Boston College. And Rich Bernstein has become a friend over the years. Rich, I'm a big fan of Rich. He gets my emails, and he must cringe when he gets my emails.
Not at all. Not at all.
He's the chief executive officer, chief investment officer of Richard Bernstein Advisors, which he founded in 2009. The firm utilizes a unique top-down approach to investing, focusing on macro trends rather than individual stocks, and it's forward-looking, as it says on the website. Mr. Bernstein has over 40 years of experience on Wall Street and was formerly the chief investment strategist at Merrill Lynch and Company. And a side note, and Rich, if I don't get it right, correct me, you worked for and kind of was mentored by and a colleague of Chuck Clow.
Absolutely.
For years. Our own Chuck Clow was a trustee and a major figure in BC's history over the last 30 or 40 years as a trustee and also an alum. And Chuck was also at Merrill for years. Rich is a much-noted expert on equity style and asset allocation. He was voted to Institutional Investor Magazine's annual All-America Research Team only 18 times. He's been inducted into the Institutional Investor Hall of Fame. His book, Style Investing, Unique Insights into Equity Management, is widely viewed as a seminal book on style-oriented investment strategies. You also wrote a book called Stop the Noise or Navigate the Noise, which I really like as a book. Mr. Bernstein currently sits on Hamilton College, a great NESCAC school, Hamilton College Endowments Investment Committee, where he's an alum of Hamilton. He's a trustee of Hamilton College. And Rich and his wife, Christine, endow numerous college and university scholarships designated for underrepresented students interested in business and STEM. Rich holds an MBA in finance with Beta Gamma Sigma, Beta Gamma Sigma. I also have that from BC. Just threw that in. That's the same as Phi Beta Kappa. It's really good student. Rich is from NYU and a BA in economics from Hamilton. And so you also lecture at NYU or taught there. We just stole Paul Romer from NYU.
Yeah. Good move.
Good move. And so Rich is great. Also his firm, I've followed it, they're voted kind of the best place to work award, and they do a lot for the people that work there, families, people with families, and so forth. And I think it's a really interesting approach to the professionals they hire and so forth. And there's also he's a great Twitter expert. He's great with Twitter. They're funny, great sense of humor, and you can follow Rich on Twitter. And Marc Seidner, we'd all know. and he's here. He joined us after lunch. He's on BC's executive committee of the trustees, which is really the top committee of trustees, and that's why he couldn't be with us this morning. So with that, we have 2 experts here. We have some experts in the room, and we have people like me who aren't experts. Let's have a great discussion on investments and the playbook and what these 2 experts think, and whether you might disagree, we can have a lively discussion. Now, I'm just going to start off. I didn't know if I was going to start with this or not, but it's a specific question. And so it might be a short answer, and then we can get into a broader question. But I'd like to just talk about one investment that's been nagging me lately, Bitcoin. Now, you might say, why? You really are an amateur, Andy. Why are you starting with Bitcoin? Well, because Rich has interesting views about Bitcoin, or Bitcoin, as you call it. And you've been comparing Bitcoin to the Turkish currency for months as it tumbled. And a builder I know kept telling me to buy Bitcoin at 16,000, but I listened to you. If I listened to the builder, I would have made a lot of money. But I'm just in general, let's just get a little Bitcoin. I'm not even sure it's an asset, or it might be pure speculation, but it is something that is out there, and it's real. Thoughts on Bitcoin as an investment looking forward? Just
Do you want us to run this?
No,
Okay.
please.
you guys decide.
Well, thank you, Andy, for the introduction. I just would remind everybody, if the introduction sounded good, it's because I wrote it. So I always have to throw that in. It's always embarrassing to hear it come back to me. But Bitcoin, I think, look, we've described Bitcoin, cryptocurrencies in general, as being the world's first true global financial bubble. Most financial bubbles are kind of local. They occur in one market, very often local. This is probably the first true global financial bubble. It has all the characteristics of a financial bubble. We've written about this a lot. If you want to see some of the detail on that, our website is rbadvisors.com, and there's plenty of stuff written on that. But it does fit all the characteristics of a traditional financial bubble. And the one that I think is most interesting among these characteristics, and the one that I always bring up, is that every financial bubble has an element of democratization of the market. Everybody gets to play. Right? If you remember, those of you who are my age, remember the tech bubble, you remember real estate, it was everybody gets to play. And we've leveled the playing field. That theme is in every single bubble in history. And think about the cryptocurrencies, that's exactly what the whole thing is all about. And so I don't think of it, Andy, as an investment at all. I think of it as pure speculation. I think that what's going on right now and why it's rallied is that investors believe the Fed is going to pivot, to use the word of the day, and that we're somehow going to return to an environment of cheap and abundant liquidity. Cheap and abundant liquidity is the lifeblood of speculation. So what you're seeing in a lot of these more speculative assets that have rebounded is people trying to front run the Federal Reserve. Of course, we don't think that we're ever returning in the near future to a period of cheap and abundant liquidity. That was something that we experienced for the past several years or whatever, but we're not going to see that again. But I think that's why your friend the builder is making me look like a fool.
Yeah, he really is.
Yeah, he is. Thank you.
I think you're right. I stay with you.
Thank you.
Okay. Mark?
Couple thoughts, but first of all, thank you, Andy. And unlike Rich, if you didn't like my bio, it's not because I wrote it, it's because Andy wrote it. So blame him. And just a fun fact on Andy, I just heard that when he's on the road, he tends to drink Diet Mountain Dew,
right,
which I said is like jet fuel. So I'm gonna change I'm gonna stop referring to Andy as Dean Boynton when I see him. I'm gonna start referring to him as Maverick. So
Every morning at 5 a.m.
Yeah,
I'm ready.
So keep it up. Look, a colleague of mine, I'll probably agree with Rich, so I'll keep it short. But a colleague of mine, a few years back, probably more than a few years back, classified Bitcoin as a solution looking for an illegal problem to solve. And I'm still not unconvinced that that's not the right way to classify it. And on a slightly more serious note, I mean, I tend to agree with Rich. I think currency is a misnomer. I don't think it is a store of value. I don't think it is a means of exchange. I mean, I would not want to, if I was a landlord, I would not want to get paid in Bitcoin because it's just far too volatile. It goes up, it goes down, and you need to build out your business plan on some form of stability. And so I don't think it's currency. A pension plan manager that I was having a conversation with about a year or so ago classified as a diversifier within the portfolio, not unlike a tech stock. And so if you want to think about it as a diversifier as part of a technology basket rather than an alternate currency would be my.
Okay, thank you.
Thanks, Maverick.
Let's think about going forward. And Mark, we'll start with you. Is we come out of COVID. We're coming out of the Federal Reserve, raising rates. Whether you think it's enough or not, I don't know. Rich keeps saying that we're still facing serious inflation, at least when you read his tweets. But the Federal Reserve action, we're facing the, what do we call it, the cliff? What's coming up? The debt limit, any week now, which is kind of near term, but it still could be significant. When you think about going forward, in terms of investment advice and just what classes of assets, geography, is Is it still the same as what it was pre-COVID, which was tech and kind of more speculative assets? Or what do you think if you look for the next 5, 10 years, Mark? What's the playbook going forward?
I mean, I just think it's a super treacherous environment in the sense that and I'll talk about the financial sector in a second, but the cumulative effect of 500 basis points of interest rate tightening in 12 months has never really been experienced. And so I think the word of the day, whether it be pivot or soft landing or no landing or whatever, or hard landing, I just think it's not the right nomenclature in the sense that we've never navigated this type of environment. It seems to me that recession is highly likely. They all repeat. I mean, we're in an academic setting. What do you learn in Econ 101? Monetary policy acts with long and variable lags. And maybe they're a little bit more variable this time than previous times, but they tend to be long. It tends to be 12 to 18 months. And guess what? We're 14 months into a tightening cycle. So it's about to hit like ground zero. And so I think that there's no doubt that we're heading for a much more treacherous economic environment, which I would say is a much more treacherous financial market environment. I mean, the adage is that central banks tighten until something breaks. Well, something broke. I mean, we've had 3 major U.S. financial institutions, and they feel not that major, but when you have the cumulative effect of $200 billion in assets here and $150 billion in assets there, it's not insignificant, and a 6-day decline in Credit Suisse from what was a healthy going organization that had some management issues but had a business plan, had convinced investors they had a stated business plan to turn their business around that was going to take 2 to 3 years, but it collapsed in 6 days. And I think that's evidence of breaking. I'm an old school honors economics degree holder. Thanks, Rich and Andy for penciling that in. But I don't think a yield curve, an inverted yield curve, necessarily is a precursor to a recession. But it certainly is an indicator that has a pretty decent track record, and it makes sense. We live in a levered economy, and levered economies work when you can borrow short and lend long and make money doing it. And when you can't make money doing it, you know what you do? You stop doing it. Like, you're all smart business people. Like, what's the old saying? Like, we lose money on every transaction, but we make it up in volume. Like, no, that doesn't work. When you lose money on every transaction, you stop doing it. And by the way, banks aren't supposed to fail because they own too many AAA rated treasuries and mortgage-backed securities. Like, that's the anomaly here. We haven't even had the credit books get written down, or impairments on business lending or in fact real estate lending. And I think there's a credit crunch to come, and I think that makes, again, as I've said a few times now, a pretty treacherous environment. And like, I'm a 35-year bond market veteran, so anything I say about the equity market, just do the exact opposite, because it is like the economist cover effect. But I think bonds are beginning to look pretty attractive. The yield on BBB rated credit is the earnings yield of the S&P 500, and that never happens. And to me, that's sort of the sweet spot of investing these days.
Okay, so bonds, basically, right?
Yeah.
And junk bonds.
No, definitely not junk bonds. Definitely not junk bonds.
BBB and better.
BBB and better.
Okay, all right. And that's from PIMCO bonds, I think.
I'm not biased.
Yeah, you're not biased.
I'm not biased.
No. And you're a high honor
I'm not
student
selling
too, Mark,
anything.
whatever you say. Rich, what do you think? You had an interesting, yesterday, a tweet where you pointed out mid-cap industrials have done really well. You're really looking at these kind of different classes than we're used to thinking about. What do you think we should be doing going forward?
So the way I think of the market, I think too many people are focused on the market, and I don't think that's really where the excitement's going to be over the next 1, 3, 5, even 10 years. I think you should think of the market as kind of a seesaw, with the fulcrum of that seesaw being the market. And on one side of this market right now, we've got all this sexy stuff still sitting there. And the other side of the market, we have everything else in the world. And so it's funny because people portray us as being so bearish because we don't like what everybody else likes. We don't like US tech. We don't like US consumer discretionary stocks. We don't like US communication stocks. Maybe we can throw in financials just for fun right now. But those 3 sectors dominate the US market. Everything that's gone on, they're still almost 50% of the US market. No other developed market is as concentrated in those three sectors as the United States. We are very, very exposed to those three sectors. In fact, if you haven't heard this, Microsoft and Apple now comprise the largest proportion of the two stocks ever made up of the S&P since IBM and AT&T in 1978. And most people say, well, yeah, they have to be core holdings. My response to that is, what an amazingly bearish view of the world that only two stocks present growth opportunities anywhere in the world. There's nothing in the fixed income market. There's nothing in the equity markets around the world. There's nothing in commodity markets, alternatives, nothing. There is nothing other than those two stocks. What an amazingly bearish view of the world. I just don't think the Nifty 2 is something that we should be investing in. There's got to be something else out there somewhere. I mean, just by luck, shouldn't we just like come across something that surprises people? I mean, 50% of the S&P's performance attribution is attributable to three stocks. It's attributable to Apple, Microsoft, and NVIDIA. That's it. 50% of our market's performance attribution is three companies. How ridiculous is that? Think about that logically for a second. How utterly ridiculous is that? Is capitalism ending? I mean, this is crazy. So think of the world as a seesaw. That's kind of the way we're looking at it. And on one side, you have all this tech, innovation, disruption, everything else. On the other side, you have everything else in the world. Now, to Andy's point, the one that I keep referring to is, I'm sure you all know ARKK, the ARK Innovation Fund, right? It's all tech innovation. It's so sexy. It's exciting, right? Well, ARKK came public in October of 2014. And since ARKK came public in October of 2014, small and mid-cap industrial companies have outperformed ARKK. I'm going to bet not one person in this room knew that. Andy does, because he reads our tweets. But I'm going to bet you didn't know that. Maybe there's a story out there that people aren't aware of, that maybe real productive assets, stuff that actually does, that's meaningful to the economy. It's not all about cute wiener dogs in the metaverse. That maybe that's where we should be looking, on the other side of the seesaw. So I don't think it's, Andy, I don't think it's so much the market, so to speak. I think it's which side of the seesaw you're on that's going to be the big excitement over the next 5-10 years.
When you both think about international markets, whether it's developed or emerging markets, or emerging or developing, what do you think about those? Mark, I don't know if you have views about bonds there or overall. And Rich, what are your views about the non-U.S. markets?
You want me to go first?
Go first.
I'll go first this time. So non-U.S. markets is I said this very briefly, that the United States is pretty much alone in our concentration of those three sectors that I mentioned. The rest of the world is not. And in 2022, 70% of non-U.S. markets outperformed the United States equity market in dollar terms. So despite the fact that we had a strong currency, 70% of non-U.S. markets outperform the United States. And the reason why is because they're not as exposed to those three sectors as the United States is. And what you will find is that 2022's performance was country outperformance was directly related to how little exposure a country had to tech, to consumer, and to communications. So if you believe, as I do, that the seesaw is here, it says there's plenty of opportunity outside the United States.
I'll give you a perspective from fixed income markets, and then maybe make a broader statement about dollar and global currencies. The rate hiking cycle, which has been, again, as we've sort of discussed, historically aggressive, has created some real opportunities. And take one example, Brazil now has 13% short-term interest rates and 4% inflation. That's a 9% real rate of return. Yeah, I mean, it's Brazil. It's the country of the future always, and so maybe that's the right risk premium. But 9% real rates in Brazil seem pretty darn attractive. And then by extension to that, you can look around the world. Dollar was so strong last year for all the right reasons. I mean, dollar, the U.S. was the shining example of still a strong economy. The Federal Reserve was earlier and more aggressive than global central banks. That created certainly a tailwind for the dollar. But obviously, as we talked with Rich Clarida, that's changing. The Fed is probably pausing, may pivot. The U.S. economy is likely headed towards recession. The dollar is 20% overvalued relative to global currencies, and so it's almost to the point now. what Rich said, to what Rich said, the global outperformed even with dollar strength. Now you're at a point where you might get global outperform and dollar weakness,
Right.
and have the chance to double dip. And so
Absolutely.
I think that's just one example of some of the quote unquote breakage that's created opportunities over the last 12 months.
The debt ceiling situation in DC. We get together, myself and some faculty, and a bunch of them are finance professors. Some are in the room. Jeff is one, and we get together and have research discussions every few months in the evening in the conference room. And me being like watching, CNBC and why what if am I going to be broke when this thing happens, when they don't solve this debt ceiling crisis? What happens to the few assets that I have? So the finance professors all said, there's no way they're going to solve it. They have to solve it. We've gone through this so many times, and I'm not so confident. But they said, don't worry about it. What do you think? Just as experts, as observers, as citizens, are we going to solve it or not? If we don't solve it, what are the implications on bonds, stocks, investments, and how does that affect the landscape?
I mean, my mother always told me don't discuss politics in polite company, and I'm assuming this is polite company, so perhaps I shouldn't discuss politics. But I'll agree with the professors over you who watches CNBC. With all due respect to CNBC,
I'll sleep. If Rich agrees, I'll sleep better tonight. Right.
I mean, I think it is a credit default swaps in the United States have and if you look at if you read other people's tweets, have spiked to 150 basis points, which some people go, oh my goodness, look, it's clearly the market's betting on the default of the U.S. It's still a 3 or 4% probability, which again in my mind is probably outstated. To be sure, it will be an 11th hour, 59th minute, and 59th second solution. So don't rule out strange things happening and increasing volatility as we head through the rest of May into early June. By the way, nobody even knows when the X date is. I mean, that's the thing. Like, nobody knows when the date is, and we probably sense it's a little bit sooner rather than later, which means that some of the discussions that have been going on this week are a little bit more important than many might rationalize. It's lunacy that May T-bills were trading with 3% yields and July T-bills are trading at 5% yields. I mean, that just seems silly almost. But again, our official view and my view as well is it'll be a bumpy road, potential volatility, which would create opportunity, but it'll get resolved. Nobody's going to go back to their constituents and be like, hey, look at me. I'm the person who presided over the default of the United States government. Vote for me. Thank you very much. I mean, it's just
Right.
Rich?
So I look at it slightly differently, but I do want to say I think we should all be I'll talk politics for 1 second. This is not a view of my firm. This is a view of me. That I think the whole kind of deficit type issue is very solvable. It's just not in the environment we're in, right? If you raise taxes and cut spending, I think we solve the problem pretty quickly. But the Republicans aren't going to raise taxes, the Democrats aren't going to cut spending, so forget it. I mean that's kind of the way I look at it. So we're going to have these problems for quite some time. I think it's a very solvable problem, but we're not going to solve it. I do think on the issue, I agree with Mark. I think the risk of default is probably lower than people think, Andy. But I do think the risk of downgrade is higher than people think. Now, why do I say this? Now, let me preface this by saying people have said there are a bazillion and 5 reasons why what I'm about to say is completely wrong. But hear me out on this one, okay? In 2011, we got to the 11th hour, they solved the problem, and then we got downgraded. And almost to the day, I'm exaggerating a little bit, but almost to the day, U.S. Treasury started selling at a significant and consistent risk premium to German bonds. For years and years, they would go back and forth and back and forth and back and forth. Sometimes one would have the higher yield, the other one would have the higher yield, one would have the higher yield, back and forth, back and forth. Since 2011, Treasuries have consistently had a risk premium, and that risk premium's averaged about 100 to 200 basis points per year. That's a significant increase. Now, if we were talking about corporates, and corporates have been downgraded, if we were talking about municipal bonds, and they've been downgraded, we were talking about industrial bonds, and they were downgraded, we all say, yeah, of course, there's got to be a higher yield. Somehow we get to sovereigns, and everybody says, no, can't be. And what masked it, and I think the reason that people don't understand this, is because the absolute level of interest rates fell. And so we're all going, mortgage rates are historically low. What we didn't realize was the competitive disadvantage that the United States was at relative to other economies around the world, that we were paying 100 or 200 basis points a year in extra interest expense that was getting siphoned off to, I don't know, China for buying our bonds, Japan, I don't know where it went, but didn't go back into our economy as real investment. And I think that's the risk, because if we get downgraded again, which I think is much higher than people think, that probability, our interest expense is just going to go up even more. And I don't see the positive, I can't spin a positive outcome from that, no how, no way. So I kind of think, just to sum up, I think people are overestimating the risk of default for all the reasons that Marc said. I really don't think that's going to happen. They're ultimately political animals, but they're completely unaware in Washington that there's this risk of downgrade. And that might be a bigger issue.
I remember it well. I was sitting at Fenway Park on a Friday night.
That was the problem with being at Fenway Park.
Trying to
right? I mean,
trying
to
enjoy the
fan,
2011 Red Sox, which was not that easy. And I remember it flashed across it was probably a BlackBerry at that time.
Yeah.
And the U.S. was downgraded to AA, and I planned to take the next week off and head to Nantucket. Andy had invited me fishing, but instead I changed my plans immediately. Went back, it was sort of all hands on deck at PIMCO,
Right,
as you'd imagine. It's like U.S. got downgraded. Where do you think bonds are going to open Monday morning?
Right.
And lo and behold, long bonds rallied 3 points,
Yeah.
and it was just so counterintuitive.
Absolutely.
But it was sort of an amazing moment. I mean, I think debt, and this is an important issue, right? Debt dynamics around the world post pandemic are terrible.
Yeah.
Absolutely terrible. Levels of debt to GDP. And people used to look at debt to GDP and say, well, it doesn't matter because interest rates are so low, debt servicing is so low, it's not going to cost you anything. Mm-hmm. Well, that worked until interest rates are 5% around the world. And we're going to spend $1 trillion. We're going to spend $1 trillion on debt service this year. And that's with an aged debt stock where the WACC, where the weighted average coupon is well below if you had to refinance everything today. Now, you don't have to refinance everything today. But the amount of productive resources that are going to go into servicing the debt in much of the developed world over the next, over the secular environment, the next 3, 5, 7, 10 years, is exorbitant, which is going to slow economic activity. There is absolutely a crowding out effect taking place, or it supports a rationale that 5% really isn't a neutral level of short-term interest rates. It's just the debt burdens and the debt service expense are becoming so problematic. I mean, to your question on high yield, sorry to talk so much.
No.
If you look at the bank loan market, floating rate, fantastic. And it was a great asset to own last year because as interest rates rose, returns rose, and it was one of the only fixed income sectors that had positive returns last year. Now, the counter to that is what's good for the investor last year is really bad for the companies this year. And when you're borrowing at LIBOR plus 250 and LIBOR 0, that's great. When you're borrowing at LIBOR plus 250 and LIBOR's 5%, that's a problem. Actually, you can't say LIBOR anymore; it's illegal. So right. SOFR or a short-term funding rate. When you're borrowing at SOFR plus 250, it's 7.5%. That tips free cash flow positive companies into free cash flow negative companies real fast. You know what happens then? Not only the United States gets downgraded, but there's a whole swath of levered finance corporate companies that get downgraded. Once they get downgraded, default probabilities go up, spreads widen, cost of funding goes up. It creates this vicious cycle that is completely the opposite of what we've experienced the last decade or 15 years as investors. And again, either rates are going to come down because they are going to have to, or things will continue to break. And first it was the commercial real estate sector, then it was the financial sector. Next it will be small and medium-sized businesses where most of their liabilities are floating rate. And I don't want to sound overly macabre, but it's inevitable. Sorry, Andy.
It's depressing.
Well, we had a bond manager.
We had a talk about energy. I mean, it was a great talk, and the notion of zero base, but we get down to 2 and 3, and hope fingers crossed that where's my friend John? Yeah, what do you call the things that the sinks work? If the sinks don't work, we're really in trouble. And then we heard from Megan that we're in a world of competition, not a world of cooperation, and we're going to face these big battles with Soviet Union, China, and so forth. And now I didn't understand it all, but doesn't sound great.
Neither did I. That's okay.
Yeah, it doesn't sound great that we're going to have all this money going to servicing debt, not into productive assets, making things, fixing bridges, the Holland Tunnel, which Rich uses, at one point uses to get into work. That was another tweet he had. But it's not a really great view looking out. It's complicated the next 5, 6, 10 years. Let's take some questions from the audience.
There's a parallel in my mind between the climate change focusing on this debt limit. Step back, say U.S. debt as World War II. So your perspective is like a 10-year or less, really, when you're thinking about investments. Are there thresholds on debt service and so forth that the U.S. government's going to get to? Like the debt we have right now doesn't count the unfunded Social Security obligations that we have, and that's supposed to run short within a decade. Are we just too big to fail and we don't have to worry about this? We can just keep borrowing and borrowing? Or are there any kind of thresholds you think of that we're starting to get into real trouble?
So my response to that, do you want me to?
Yo, yeah, go.
No, so should I repeat it? Could everybody hear that? I don't know if everybody could hear the question. Yeah, you could hear it, okay. Couldn't hear. I'm going to paraphrase. Is there a limit to how much the government can continue to borrow, basically, and do we just keep sucking up more and more of private sector cash flow? I mean, is that a good way to paraphrase it?
In your outlook for
Yeah.
10 years or so, is there a threshold that you've identified that you start to get worried?
Is there a limit in like as you look at 5 or 10 where you start to really get worried about it? I think that we've been spoiled. If you think about Mark's comment from before, we were in a period of expanding globalization. And with that period of expanding globalization, we bought everything from the rest of the world, and in exchange, we kind of sold them our debt. That's kind of, I'm exaggerating to make a point, but that's kind of what happened. As globalization starts to contract, which is one of our main long-term themes at my firm, is that globalization is slowly going to contract. A lot of that starts changing, right? I think my personal opinion is that we are looking at a period that we're going to shift from secular disinflation to secular inflation. Not because of the debt overhang and all those kind of things, but simply because we don't make anything anymore. We have a massive trade deficit that made no difference for many, many years because globalization was consistently expanding. Now that economists don't talk about the trade deficit anymore, guess what? Globalization is starting to contract. That we're going to have secular inflation because we don't make anything, and so competition's going down. That's the way. What globalization basically did was increase competition for 25 or 30 years, the opposite of antitrust. Right? If you think about why we have antitrust rules, it's that one company doesn't dominate it. That's you probably know a lot about antitrust more than I would.
No, but Simca does, Barkai, so we can talk about competition.
But anyhow, but what globalization did was it just kept expanding competition, and therefore we had secular disinflation because if you expand competition, you get downward pressure on prices, not upward pressure on prices. Well, as that starts to reverse, we're going to start reversing this whole thing. So I think one of the questions that we should be asking is kind of how does the United States, as a highly levered institution, if you will, deal with that change? Now, some people would argue, well, of course they're going to do that because you inflate away the debt. Maybe that's what's going to happen. I think necessity is going to force us to both cut spending and raise taxes. I think I think if we come back in 10 years or 15 years or 20 years, God willing, I think we will be talking about very different issues than we're talking about today. I think we should all expect higher taxes. I think it's inevitable. I think we should all expect lower rates of spending. I think that's inevitable too. And you put that all together with a little inflation, and I don't think it's the end of the free world as we know it. That's kind of the way I'm viewing it.
I mean, just briefly on that, a lot of it comes down to a question of whether or not you think the debt is being used to invest in productivity enhancing investments.
Yeah, absolutely.
And if they are productivity enhancing, then you can grow your way out of a debt burden. So, and again, I'm somewhat skeptical, but I don't think filling parking lots with EV chargers is productivity enhancing.
No.
In fact, I think EVs are productivity destroying. Who has an electric vehicle? So I just got one. I got a Rivian truck. That's an advertisement because we were a portfolio investor in Rivian, and I think it's a fantastic product. But I literally drove it for the first week, and the battery went down to 30%. I'm like, oh, I'm gonna charge it, fantastic. So I'm like, I'll charge it in the office. Why not? I go into the office and I plug it in. I'm like, charges 11 miles an hour. Like if I ever actually take this somewhere where I've got to like charge it, I'm gonna be sitting drinking. I'm gonna have like 13 cups of coffee in me and like never be able to leave. And so I'm not sure it's productive. I mean it's an anecdote and it's meant to be somewhat funny, but somewhat provocative. But if you believe if you believe that the world is going to invest in productivity enhancing enterprises
Absolutely.
through the debt creation, then it's solvable. To Rich's point, there's 4 ways out of bad debt dynamics. You can repress your way out, which is extraordinarily low rates of return led by extraordinarily low bond yields. You can default your way out, which we all know is not a great way out of bad debt dynamics. You can inflate your way out. I think inflation's. I'm not overly concerned about inflation, but it's certainly not going to be the levels we've seen over the last 15 years or so, and it will probably be much more volatile than it's been in the past. Or you can confiscate your way out, and Rich is probably right. I mean, there's some form of higher taxes, higher burden, higher regulation that's just going to take more money out of the system to fund the public sector and the debt, and none of that's great for growth of the outlook.
Other questions? Yes, ma'am.
Yeah.
20 minutes.
Agree.
Thank you. So 20 minutes to charge your car, right? That's available. So earlier, Rich said something about that PIMCO is focused on what sectors are going to be impaired, not as much as what the recession is going to look like. So you guys mentioned a few sectors, but you didn't mention real estate. Just curious, what are your thoughts on that? What are their cap rates? What do you think they're going to do? They've done? Just broad question,
Okay,
but...
so when you don't really know the audience, I'm sure there's some real estate people in the audience. So this is a unique opportunity that I can make a fool of myself. But I
let me
think,
follow up and make a bigger fool out of myself. So, yeah.
but let me tell you my view on real estate. I think the real estate industry right now, well, let me step back for a second. Our whole theme, our long-term theme, 5, 10, 15, 20-year theme in our firm is that we are moving, as I said, from an environment of cute wiener dogs in the metaverse to real productive assets. That's the story of the future. Getting back to what Marc was saying before, it's assets that either benefit or fight inflation. That's our whole theme. And as globalization's contracting, we have to make more of our own stuff. That's going to be the big theme. Okay, so how does that go into real estate? Real estate investors are still very much service-oriented. Think about hotels, think about office buildings, think about even to some extent what's called industrial real estate is really just warehouses for Amazon. I mean, that's really all it is. The real estate industry will, I think, 5, 10, 15, 20 years, will reorient itself to talk about manufacturing real estate, right? So here's a way to think about it. Ford has several F-150 plants. They own the plants. They own the real estate. What a waste of capital. If you're Ford, why in the world would you want to own the plant and own the land when you could be using that to blow Tesla out of the water? Think about the amount of capital is tied up there. I don't know this for a fact, but I think that semiconductor plant that everybody talks about, because it's like the only thing we can talk about in terms of semiconductors, is in Ohio. I'm pretty sure the company involved is going to own the factory and own the land underneath. What an incredible waste of capital. My guess is that the real estate industry will change the same way that hotels don't own the buildings the hotels are in, right? Retailers don't own the buildings that they sell the stuff in, right? Then we will find that will go to manufacturing, and real estate will reorient itself from services to manufacturing as well, if we're right. If you believe our story, that's going to be what I think happens in real estate.
I don't disagree with that. I mean, I think there's a couple of interesting dynamics in real estate. First of all, a lot of it's held in private equity-like structures that have not taken the mark, right? And so when you look at a company like SL Green, which I think is either one of the cheapest companies on the planet or maybe one of the most expensive pitfalls on the planet, most expensive mistakes on the planet. I mean, this is a company that owns Class A plus New York City office real estate. It trades at 30% of book value, trades at 3 times fund from operations, and has a 9 or 10% dividend yield. By the way, remember what I said about bond investors talking about equities? So like, please ignore everything that I'm saying. But I mean, I think that speaks to how cheap the public side of the equation has become. The private side is still basically marked at par, and here's a public, enterprise that's trading at 30% of book value. I think that's a real issue. The taking of marks on private investment vehicles across the investor universe has yet to take place. And normally these drawdowns have been so short because the Federal Reserve comes in or central banks come in and flood the market with liquidity. It's like, well, I didn't know why I have to mark it down. Like everything's back up to par again. But this cycle is obviously different. I mean, when you underwrite to a 3% cap rate and a 4% all-in borrowing cost, when your cap rate goes to 7 or 8 and your borrowing cost goes to 9 to 10, you know what happens to the value of buildings? It goes down a lot. Now that is a problem that's yet to feed through. One of the real questions is how lenders are going to behave, because there's either going to be a wave of equity being completely extinguished and keys being handed over to a bunch of investors that don't want to manage or control properties, or there's going to be an extend and pretend cycle that's just going to raise the coupon by 50 basis points or percent and kick the maturity out 7 to 10 years. The more likely is the latter, particularly with the focus on the regional banking system and concerns not just about the treasury and mortgage portfolio, but the potential for commercial real estate write-downs. But it's a pretty tricky environment, which, by the way, look forward a year from now, probably will be an incredibly interesting investment. Maybe not even a year, could be 6 months from now. Probably will be an incredibly interesting investment opportunity, but it's like looking from mountaintop to mountaintop. There's a valley in between. You got to get down it before you can get to the other side. Unless somebody's going to come in and bridge it. Unless there's a clean balance sheet that's going to come in and bridge it, and it just doesn't. I mean, we look around the world. There just aren't that many clean balance sheets. There are a few banks that have clean balance sheets. There are a few investment companies that have clean balance sheets. But think about like all the pension plans that thought they were underinvested in private assets and wanted to buy commercial real estate, wanted to do private credit, and then their public side went down 20%. Now they're fully invested on the private side. They got a denominator effect, and unless you can find a clean balance sheet, some of these risks are gonna play out. And again, it's not depressing, because I think at the end of the day there are going to be clean balance sheets, and there are going to be incredible investment opportunities. But it's probably going to require a little bit more patience because you haven't had the marks yet, and you haven't really felt the pain.
Next question. In the back? Yes, sir.
On SPACs.
I repeat everything I said about Bitcoin.
Yeah, it's not that far off. The only thing I would point out is that the notion of a shell company is not new. Throughout financial history, there has been some form of a shell company that has popped up from time to time. They've had different names, obviously not SPACs, but the concept of the shell company isn't new. And the fact that we don't know that shows that they fail on a regular basis, and then they just seem to come back. So that would be my 2 cents on them.
I think, by the way, I don't know if Malcolm Gladwell said it this morning, but he said something in a breakfast we were at that I thought was really smart. It speaks to, zero interest rates for a long period of time, which creates the complacency, which means that mistakes can get overlooked very, very quickly and very, very easily. And I think, and I don't know if you're much more knowledgeable than I am, but my sense is that the whole concept of the SPAC came out of a zero interest rate environment, free money, a need to find something quickly that you could leverage and turn into a quick hit. Yeah. And that I think historically, Rich sort of alluded to, is a recipe for.
Can I expand? Do you mind if I expand on that just a little bit? I think one of the things that we've repeatedly told our investors is that you have to understand that financial bubbles are inherently inflationary. And the reason why is because they grossly misallocate capital within the economy. You allocate capital to things you don't need, like Elon Musk wanting to go to Mars, or Richard Bernstein going on space vacations, or all these kind of weird things that people came up with. Everything works when the hurdle rate is 0. Right, go back to your corporate finance class, right? When the hurdle rate's 0, let's go take a flyer, right? As the hurdle rate goes up, you have to make more rational decisions. And so when the hurdle rate was 0, the economy was making boatloads of irrational decisions. Mars, space vacations, SPACs, personal helicopters. There was a company in San Francisco that was buying rooftops in New York so that you could land your personal helicopter. Obviously, that group didn't know the history of helicopters in New York and had never heard of the Pan Am building and why the top of the Pan Am building is flat, but yet no helicopters land there anymore, but that's another story. It was such a great idea. That's what happens when the hurdle rate is 0, right? Is you just do completely irrational things.
Yes.
So hello, my name is Claudia Russell, BC grad 91. I'm a First Republic Bank employee, but I'm not speaking on behalf of First Republic, so I have to make that very clear. I want to know what you guys think about the whole banking crisis, because I'll tell you as a First Republic Bank employee that may not have a job next week, it's something that we were all told increase deposits, but we kind of got painted with a Silicon Valley brushstroke, and we're a great bank, great culture. I'm really going to miss the people that I work with. And to be honest, JP Morgan is based out of Delaware, and this Dominican girl that came to Boston College to go to school here does not want to leave Boston. So, what do you guys think? How could we have prevented it? Because to be honest with you, we tried to do everything possible, and we felt like a lot of the employees, me personally, felt like we got brushed with that stroke, to be honest.
First of all, I think there is an element where you got brushed with the same stroke. You know better than I do because you work there. But as far as we can tell, First Republic was a premier institution doing something that no financial institutions do anymore, which is actually service clients and actually care about clients. And I think that's, I hope at some point, and it should, I hope at some point that business model is replicated. And if I was an enterprising person looking for a business to invest in, I think trying to replicate First Republic's business model and franchise value from that perspective would be an incredibly strong idea. I know a lot of people that I work with that banked at First Republic and will miss the people that they worked with. Look, I think on the other side, and I'll borrow Warren Buffett's words because he talked about this at Berkshire's meeting, whatever it was, not last weekend, but last weekend.
Yeah.
And I think when you're a private institution and you make 10-year jumbo mortgage loans at 1.5% or 2% interest rates as part of servicing those clients, and you're short an extraordinarily valuable option because that client can refinance that loan in a heartbeat. But if interest rates go up 4%, and that loan's got a 10-year duration, you know where you're marking it at? 35. You're marking it at you're losing 35%. You're marking it at 65 cents on the dollar. And I think that's emblematic of maturity transformation and the challenges. And again, there's others that are much better experts than I am. But I think on the one hand, the client service model was outstanding, and hopefully will get replicated by some financial institution. But the flaw of the business model was the relationship loan that was too low of an interest rate, with too long of a maturity, with not enough amortization, and in an environment where rates rose just far too rapidly, far too much.
Nobody foresaw that. Nobody foresaw interest rates going up so fast, so quickly, and you can plan the best you can, but I don't think anybody could have foreseen what happened the last year.
Well, I think there's another implication there, which I think all of us have to face as investors and perhaps even employees, which is the rapid dissemination of information and the disruption that creates. One could talk about Twitter. it's very possible that if one prominent, financier didn't tweet about Silicon Valley Bank, and that it might still be around, because there's a reason there's mark-to-market accounting. You're not supposed to worry about it because you got time to figure it out. You're supposed to have time to figure it out. And it's quite possible if one investor didn't say in a very public manner, would never put another dollar in Credit Suisse, the Credit Suisse might still be around. And I just think we have to be extraordinarily vigilant, both as business managers on the one side and as investors on the other, that the luxury of time just doesn't exist like it used to. Things are moving at warp speed, at light speed, and there'll be plenty of research to be done on that front. Hopefully BC takes the charge on it. But the management of liquidity, such that you can survive mark-to-market losses on a lot of assets, but when you run out of liquidity, it's the proverbial tilt on the pinball machine.
Thank you.
So my take on this, and I'm not referring to First Republic because I really don't know First Republic at all, but if you just think about the banking sector overall, my cynical response when this comes up is, what did people expect, right? The Fed is tightening very aggressively. When the Fed tightens very aggressively, how do they get monetary policy into the economy? They make it more difficult for banks to do business. That's the whole point of monetary policy, is to make it, we're all taught about, the Fed raises rates. In the old days, when I was in college, it was literally the term disintermediation was used because savings and loans could only have their deposit rate up to 5%. There was a limit on what they could offer. And the Fed would literally raise interest rates higher than 5% to, quote, disintermediate the thrifts. Okay, in other words, that's how they worked on the economy. They made the cost of lending, the cost of borrowing, the cost of funding rather, too expensive relative to what you were going to get on your mortgage. That stopped mortgage lending, slowed down the economy, blah, blah, blah. That's basically what we've seen. But we're in an environment, as Marc pointed out before, of increasing leverage in the system and everything else, so things happen. And I don't, look, the yield curve inverted in the United States probably 8 months ago now. Was there something like that?
More.
I don't think too many risk managers in regional banks changed their probabilistic outcome of what their cash flows were going to look like. So my answer is what did people expect? This is what should have happened. History shows that when the curve inverts, it takes about 8 months, take or leave a little on that, roughly about 8 months for the regional banks to start coughing up blood. And guess what happened? They inverted the curve, and now the regional banks are coughing up blood. Now we could argue whether they deserve to be this. We could argue, is there short sellers and everything else? Yeah, I get that. But I'll remind you, my first time in my career where this occurred was 1984. It was Continental Illinois. It was the 6th largest bank in the United States. And we survived. But a lot of the things that people are saying today about the moral hazard of raising, insuring deposits above $250,000 and everything. Well, what do you think they did with Continental Illinois in 1984? They insured deposits above $100,000 because that was the limit back then. They insured deposits over $100,000. This is not the first time we've seen any of this. So I think we'll live through this. I think it'll be fine. But this is how monetary policy gets injected into the economy, is making it more difficult for banks to do their business. And if you're extended and you're not well diversified and you don't have risk management, I honestly don't know what people expected. I'm not saying that that's the story for First Republic in any way. Don't misunderstand my point. But I think that it's not the first time this has happened. It won't be the last time.
Last question, Dan Holland. Make it a good one. You can speak loudly. Just project that way.
That talked about the impact of servicing that debt. We talked about deglobalization and fragmentation earlier today. My question is really about the position of the dollar as a reserve currency. In your model, where you look out 15, 20 years, is the dollar still the reserve currency? Because that's really what enables this whole game, if you will.
So I think people.
Thank you for going first.
Yeah, I'll go first on this one. I think. Well, no, I'm not really going to give an answer, but I'm going to talk a lot, but I'm not going to really give an answer. I think people expect a lot of these things to happen. Like we wake up one morning and we're Botswana, right? That it's a sudden effect. And I don't think that's reality. I think it's more like a slow bleed. It's water torture. And I think, honestly, I think we have been down, we're on that road already, and we are just progressing. So it's not that you're going to wake up tomorrow morning and learn that all of a sudden we are trading oil in renminbi or whatever, the yuan or whatever. I don't think that's going to happen. But over the next 5, 10, 15 years, where more commodity trading be in other currencies, yeah, I'd say probably already happening, right? I mean, although not on the exchanges, but it's probably already happening.
I mean, I think it's an extraordinarily low probability, simply for the observation you can't replace something with nothing.
Yeah, right.
And unless China, Europe's just not stable enough, Japan, UK just aren't big enough, and unless China wants it, which I don't think they do, and they make their currency completely convertible, which they won't, you can't replace something with nothing. So I was a honors econ major. I did well in econometrics, and I know that you're never supposed to give a 0 probability or 100% probability, because somebody will always take the other side, and there's no way of winning. But I'd come pretty close to a 0 probability that over the next 5 years, the dollar loses its reserve currency status. Now, the follow-on question is whether or not the U.S. decides to lose its status as the global police person and the security provider, which is an even more interesting question, because we're increasingly in this multipolar world where countries are looking to China for their economic growth and to the U.S. for their security. And that's really an unstable system, right? Because it's like one's getting a benefit, and there's, again, not to talk politics, but there's universal view in Washington, and it polls extraordinarily well that China cheats and China's unfair, and we've got a disadvantage. But if we're paying to protect the world who's looking to benefit from the economic advantage of China, that's the question you think about over the next 3, 5, 7 years. How does that solve itself? And I wish I was smart enough to have an answer. I'm sure there's someone here who's going to be smart enough to have an answer, but that might be the question that Andy's got the answer.
Andy,
that could be the question that
before
really
you sum up, can I add one thing?
You
I
guys
think
are on a roll.
I hate ending on such a bearish note, and so I want to ask Eric. There's got to be. I just want to
existential note of destruction.
Because you and I, you do dinners as I do, and the last question everybody asks is, what keeps you up at night? Okay, and it's always like this horrible thing, and everybody leaves. Oh my God, like this is like the world is ending, right? Like, and I want to ask a rhetorical question. The rhetorical question is, why does Warren Buffett own a property casualty insurance company? And the answer is that human beings always overestimate the probability of bad things occurring. And if you know what the real probability of a good actuary, you know what the real probability of bad things occurring is, and you know what people think the probability of bad things occurring is, the difference between perception and reality is called cash flow and pure profit that you can go and invest someplace else. And so as we talk about all these bearish things going on in the future, just keep that in the back of your mind. Why does Warren Buffett own a property casualty insurance company? Because people always overestimate the probability of bad things.
Let me ask you a question.
Yeah.
Would you insure your car if you didn't have to? Would you insure your house if the bank didn't require it?
So
or would you self-insure?
I think that it would be a different calculus. My guess is I probably would, because I'd be scared that somebody would sue me.
You sound like a bond manager.
Yeah, well, I'm a multi-asset guy, so I can go either way. No, we shouldn't talk about that. But anyhow, but I think, no, I mean, that would be a different calculus, right? Because you have to worry about somebody suing you and that sort of thing. But yeah, I probably would. But I wouldn't have to pay premium probably as high.
That is for sure.
Yeah. So especially being in New York and insuring a car.
Rich and Marc, that was great. Great ideas, great insights, great learnings. Rich, thanks for coming up from New York. Really
pleasure.
Appreciate it. Better than beaming you in.
Yeah,
You've been
thank
part of
you.
the conference before, and I ask, and you're very gracious to say yes.
you.
Marc, thank you for sharing. This is a different side of you with great insights. Thank you very much.
That was great.
Really good.